All right. To respect everyone's time, I'm just going to go ahead and start this meeting now. I think it'd be the best. Welcome, everyone. Feels great to be here. It's funny, all five of us, my three partners for UPC and our operator, Patrick Duffy, we're just kind of reminiscing basically of how we got to all know each other and how the interesting connections of life can bring us together. So there's some people on this call I know, there's some people on this call I do not know yet. It's all interesting though how we got connected and now we're here tonight. And that's why I feel great about presenting to you tonight. This is going to be our very first introduction meeting about Upgrade Partners Capital. Tonight, what you can expect to hear is some hindsight of what we've seen in the real estate market over the past few years from myself and from our partners, and Patrick as well, who's an operator throughout our country. Some insight to what we believe are some causes going on right now with inflation rates and interest and how that's affecting the real estate market, specifically with multifamily assets, the one that this fund's going to be focused on. And more importantly, the foresight of what Upgrade Partners Capital can do for everyone that invests with our fund moving forward. What kind of things that we expect, what are some of the strategies we're going to be doing. Patrick's going to be talking about what his philosophy is for investing with multifamily and how we align with that, very much so with Upgrade Partners Capital. So to give a brief introduction about myself, my name is Michael Mahoney. For those of you I don't know, I hope to speak with you very soon. I've been in the real estate realm going on about 7 years now, started in single family, moved to multifamily, and I currently have a position with a company called Upgrade, where we do business development, mindset, performance training. That's how I met many of these gentlemen who are my business partners here. And we're very excited to be working together because when you work with like-minded people who all have the same vision and goal, it just makes it easy and effortless. So I hope everyone here who has not invested with us yet has that same feeling when you get to work with us, that it's just easy and effortless and really fun to work with a fund like this. Now I'm going to be transferring over to my good friend Nikita and let him explain what he's been able to accomplish in his great career, and then give some oversights of our fund's targets.
Amazing. Thank you, Mr. Mahoney. Yeah, really excited to be here with you guys today talking about this fund opportunity. First, just like super high level overview of myself. I have a few different investment funds that I run. I have a small hedge fund trading futures and commodities. I have a crypto mining fund. I'm on the board of a few different real estate funds, which is really why when us guys at UPC started talking about this fund that we're going to go over, it was a no-brainer. I'm very, very excited to share some of these targets with you guys. I've been in the fund space for the past few years, actually launching and scaling a company that consults investment funds. So we've worked with a little over 350 first-time fund managers who are in all different types of industries, although most of the funds we help are real estate funds. And cumulatively, they've raised a little over $12 billion. And so we've definitely been around the block a little bit in terms of different sized funds and knowing what is really going to work. So I'm going to share my screen here a little bit and go over some of the targets today. So we are a real estate fund investing in the multifamily asset class. Our target is a $25 million raise, and our target IRR to investors is about 18%. And so with that, minimum investment is about $50,000. Now this offering, because it is a Regulation D 506C offering, is for accredited investors only, which if you have any questions about accreditation status or what the specifics behind that are, please reach out to us. But this offering is for accredited investors. And so kind of high level overview, and our amazing operator, Patrick, will touch a little bit more on this. Brandon will talk about this a little bit more. But for those who don't know, investing in multifamily, we are going to be targeting some very good growth markets. We look at a bunch of different metrics, but basically, looking at markets where there's high job growth, good increase in median income, good rent growth, really markets where these real estate assets can thrive, which is why, we can very confidently claim and project an 18% IRR. And we'll go through some of the different markets that we're going to be targeting. But really our timeline in these deals is going to be very simple. Only holding deals for about 2 to 3 years. And like I said, they'll go into some more of the specifics there to really maximize the strategy for returns. Now, the cool thing is we have a great strategy and target to keep scaling funds beyond this one and to continue to open up new opportunities to investors. And so really only just getting started here in the multifamily industry and really looking to scale to several $100 million within the next few years, because I think we have an amazing enough team to accomplish that. So Brandon, I'll turn it over to you now that I've kind of gone through some of that stuff, to take over and go ahead and chat what you want to talk about.
Yeah. So thank you, Nikita. So I come from a little bit of a different perspective in the sense that I'm not immersed in the real estate world on a day-to-day basis. I'm actually a sales leader and a passive investor. And I've always wanted to get into the multifamily space. And it seemed like a daunting task in the beginning. It's like, how do you get a deal? How do you find the right people? How do you invest into this? How do you not lose money? And so, I set my intentions about 2 years ago to actually network and find the right people and get into a safe investment. And then I invested into a fund about a year ago that actually the operator on that deal is Patrick Duffy, and who's on, one of the operators we're working with. And the returns have come in like advertised, actually above advertised. And it's my way into this world. So what I would say to somebody who's never invested into a real estate fund is it's the best way to start as a passive investor, to gain experience, to really understand the market, with it being, a safe place to put your money, especially with the volatile market and where it is now. And the cool part is like a lot of the networking and a lot of the strategy and all that has been put forth. And that's what you would be essentially investing, is to the trust of the prior performance of the operators and what they've been able to do in the marketplace. So that's kind of my look on it. And it all started with Joe. And I think that's a good lead in, is like, who's Joe, and I'll kick it over to him. So.
I was on mute. Yeah, thanks, Brandon. Grateful to be here. Grateful to be a part of this awesome team. I guess, kind of like what Brandon said, I think one of our very first conversations was, and at that time I was raising money for a 24-plex in Brigham City, Utah. And Brandon wanted to learn more. And I said, listen, there's 5 resources that you need to have when doing any deal. It's time, it's relationships, knowledge, credit or credibility, and money. And Brandon was like, because each person is going to come in and fill one of those roles. Each of us as partners fill one of those roles. And Brandon is like, I can bring money, right? That's what I can do right now. And a lot of you may be in the exact same position. You may not have a lot of time to go out and chase deals, or have done a deal in the past, but you just have money that you're wanting to deploy now. And so that's what we're doing for you, is giving the opportunity to be able to invest with us and with our operators like Patrick and our other operator, Ryan Lawless, who couldn't make it on here. And guys like Nikita as well, who have been, run billions of dollars of funds in the past. So for me as an operator, I've been doing multifamily for the last 3 to 5 years. Most of my experiences in property management, asset management, and underwriting, and I've worked hand in hand with Patrick on looking at deals and how to increase NOI. So that's kind of what we're bringing to the market is, and to you guys and to your returns, is how can we be different or differentiate ourselves in the market when it comes to value add multifamily. And I'm sure Patrick will talk about this, but we're focusing on like 1980s and newer vintage in B/A class assets, B to A class neighborhoods with low cosmetic or low value add, low to mid value add plays. So that really does hedge kind of your risk and gives much greater returns, because there's not as much that can be done. But our strategies that Patrick will talk about really will increase our NOI that not a lot of people are using, which gives us a good edge in the multifamily sector. And I've known Patrick for the last few years. He can talk to his track record. But Patrick definitely shares in our values of real estate and returns, and giving our investors a very good return, and doing all that we can to make sure that you guys get paid. So I'll let Patrick talk quickly and go from there.
Sure. Well, thank you, Joe, and the rest of the UPC team for the opportunity. It's an honor to be here tonight, and nice to speak with you all. My name is Patrick Duffy. I'm principal and co-founder of a firm named Cormark Residential. We are a multifamily value add operator. We purchased just over 4,300 units since April of 2017, and we have delivered an average net IRR to LPs of about 43%. On 3 of the transactions that we've successfully exited out of. Historically, my operating model and my business plan has been 1970s to late 1980s vintage assets, garden multifamily assets located in the southeastern United States. Many of these assets had a distressed quality to them at the time of purchase and required a large capital infusion and active asset management in order to drive and deliver those types of returns. We've been fortunate enough to work with some really wonderful vendors, both on the construction side and the management side, in order to be able to execute our business plans successfully over the past couple of years. And something that the UPC team wanted me to discuss tonight was the evolution of my strategy as it relates to multifamily, and where I see Cormark going in the future as it relates to this investment space, and in a way that UPC is going to be able to come along and invest in the opportunities that I'm seeing and originating in the marketplace. And so historically, over the last 5 years, a lot of my origination efforts and management efforts have really focused on that workforce housing product, usually dealing with a distress component, as I discussed. But what I'm seeing today in the market really frightens me a little bit. It excites me, and it frightens me a little bit at the same time. It excites me from the standpoint of the fact that I bought my assets where I did a couple of years ago. We've successfully executed on this business plan, and we're now looking to sell some of those assets. So the pricing that we're going to be able to achieve and are achieving on some of those properties is far in advance what we could have ever underwritten or have guessed that we would have been able to achieve on the sale a couple of years ago when we bought these properties. And so that's going to be a really wonderful windfall for our investors. But it's scary in the sense that we're seeing properties now trade for, I assume most folks on the call here are understanding of cap rates or what that means. But essentially a cap rate is a percentage yield that denotes basically a investor's level of confidence in the asset or risk tolerance. And so an easy way to think about it is that newer assets will tend to trade at lower cap rates, similar like a treasury bill. Those trade at very, very low yields because of the confidence associated with them. And so newer assets, lower cap rates, older assets, higher cap rates. And what we're starting to see in the market today is a convergence of those two, where we have older 1970s product trading at low 4, or even in some markets sub 4% cap rates, and yet you have 1995 and newer vintage product trading for around the similar cap rate. And typically, historically, for me speaking personally, what has been the barrier to entry with some of those newer products or newer vintage products has typically been the price point. And now that our firm has had some successful exits and has been successful at raising capital, that price point is no longer really a deterrent for us. And especially now, given the fact that these newer assets are trading at cap rates similar to older Class C assets, they almost seem cheap in comparison, and the Class C assets seem expensive in comparison. And so as it relates to kind of the old adage of sell high, buy low, I see us in a situation where a lot of folks kind of coming into that workforce housing product are buying high, and they're almost going to have to be forced to sell low. And so as a firm, we've now taken the stance and have the thesis of, we want to move into some newer vintage product that represents what we would call a first generation value add opportunity. So these are 1995 to maybe 2015 built product in some of these higher growth markets that have just not been modernized or received a cosmetic update to appeal to the contemporary renter set. And there's quite a bit of rental growth that can be obtained when making some of those cosmetic upgrades or functional upgrades. But the benefit of these properties is that they're 20 to 25 years old and not 50 years old as one from a functional obsolescence standpoint. But also there's not that level of distress that historically I've been successful at executing on that strategy. But frankly, I feel, especially with today's pricing, the level of work that's done to some of these assets to get the returns is not really worth the risk to investors. And so now the opportunity exists to buy at late 90s, early 2000s vintage properties at still very compelling cap rates in today's environment, add some very lighter cosmetic upgrades and asset manage those to performance on those business plans and still achieve very, very attractive returns. One last thing I'll say, and then I'll turn it over to the UPC guys, is Cormark Residential has recently signed an engagement with a Dallas-based investment bank named Commerce Street Capital. You can look them up. We've been working with their real estate investment banking desk now for the past couple months, and we've now signed and been approved by them and their investment committee to lead a $300 million equity raise for our firm and future acquisitions. And part of the component of that partnership is that Commerce Street will raise $300 million for Cormark acquisitions, but that will represent essentially 90% of the total equity commitment. They're then looking to Cormark to bring the other 10% of the equity on a deal by deal basis. UPC and my friendship and partnership with the UPC team is going to come in and represent a portion of that 10% that Cormark needs to bring into each one of those transactions. And so the benefit to those that would invest in the UPC fund is not only to have that level of diversification across many, many assets because of the volume of assets that we're going to be buying, but also the additional levels of scrutiny that any deal that Cormark does will have to go through, because we have these institutional investment partners that are going to be writing 90% of the investment check. So there is that additional level of institutional rigor that will be present in every one of the Cormark transactions. And so I just wanted to convey that to the group tonight, that there is a pretty unique opportunity to run parallel with institutional equity partners, given our track record and our relationship with Commerce Street Capital based in Dallas.
Awesome. Thanks for sharing that, Patrick.
Absolutely.
I hope that everyone hearing that at the end kind of gives you guys security. I know for myself and for the UPC team, that gives us massive confidence of Patrick's level of execution, his track record, that Commerce is able to come in and have that kind of confidence with him moving forward. So anyone who were to invest with the UPC team, have that same kind of, knowing that 90% of that is going to be underwriting by very large commercialized, institutionalized banks. So we have that same amount of confidence working with Patrick moving forward as well. We have another operator, Ryan Lawless, that's couldn't be on this call tonight. He has more of an off-market acquisition strategy, and there's no right or wrong here. It's just simply a different play. Patrick's philosophy moving forward is one that we do align with, along with Ryan's successful track record too. We'll get to introduce him at a later future meeting. Myself, Joe, Brandon, Nikita, we're gonna be looking for other opportunities as well. So this is what UPC is about. We're working with successful operators. We're finding our own opportunities for you guys to evaluate as well. At the end of the day, this is more a relationships business though, right? People do business with people that they like and they know. So at this time, we would like to open it up for any questions that you have for any of the UPC members and Patrick himself. If you have a question, you want to unmute yourself and ask us directly. This is a get to know us time right now. So if you get a question, you want to type it in or unmute yourself, feel free to do it now. And if not, we can. All right. All good. Well, Nikita.
Hey, I'll jump in. Sorry.
Hey, there you go.
I'll jump in first. This is Joe Mahoney. Sorry, I'm logged in twice. I called in from my truck on the phone, and then I had to log in on the computer so I could see it bigger. Real quick, Really quick intro. I'm Michael's uncle. This is primarily for Patrick. So Patrick, it sounds to me like what you're describing is that UPC is going to act as a GP fund for you. They're a piece of GP co-invest, right? So Commerce is, you're going to be collecting a promote from Commerce. What are I would have had this question generally for the UPC documents to begin with, but specifically once you bring that up, what are the economics between the UPC fund and Coremark on those types of deals? I guess for instance, and you don't have to disclose if you don't want, what would the economics between Coremark and Commerce be? But then what are the economics between UPC and Commerce as a subsidiary of that?
Certainly, yeah. Thank you, Joe, for the question, and you're spot on. Coremark is basically raising a $30 million bucket of capital, if you will, and UPC would represent a portion of that bucket of capital that would be required as our GP co-invest in any of the opportunities that we do with Commerce Street Capital. So you're absolutely right in that sense. Though the economics that we have discussed with Commerce Street Capital and their LPs would be one of a 8% preferred return and an 80-20 split. So pretty down the middle in terms of what institutions are expecting today. And it aligns also well with the UPC fund economics. And so we're really kind of running parallel in that sense. The additional benefit to UPC, however, is that out of the Coremark promote, we have a portion of that promote that is allocated towards those that are bringing capital to us or raising capital into our GP co-invest bucket. And so 30% basically of the Coremark promote is being weighted and allocated towards folks that are bringing capital to that GP co-invest bucket. And so that just allows for additional proceeds to be earned by the UPC fund by virtue of investing in our GP co-invest, which I think is another special element. We just didn't want to confuse too many folks with that math, but it's safe to say that the investors within the UPC fund will earn additional economics, perhaps more so than any traditional syndication by virtue of that component, which we can certainly provide more detail around.
And quick follow-up, when you say it's 80-20 over an 8, is that, and Coremark would be putting up 10% of the equity, is that a 20% promote over the 8, or is that a 20% cash flow, so it's a 10% promote? You know what I mean?
Yeah, it's the former. So it would be a 20% promote over the 8.
Okay, so Coremark gets its 10% pari passu share up to an 8, and then after that, Coremark's receiving 30% over the 8, which is a 20% promote on.
So we would be receiving pari passu up to the 8, and then it would be 20% after the 8.
Okay, so your share up to the 8 is 10%, and your share after the 8 is 20.
That's correct. And the 30% that I had mentioned, that 30% would come out of it'd be 30% of the Coremark 20% promote would be allocated pro rata to folks that brought money into that GP co-invest fund.
Yeah. Sorry to beat that dead horse. It's just a distinction for 30 years I've been trying to make is it cash flow or promote? And it just usually requires a second level of asking. Okay.
Yeah, no, absolutely. And I'd love to talk more about that offline as well to drill into that.
Awesome, guys. Anybody else have some more questions for Patrick, our strategy, any other teams on the team? So got a text chat right here. Are UPC members also investing or only raising the funds? We are only raising the funds for our particular one for this fund right now.
One thing I will say though, related to that Coremark co-invest bucket, I have a partner in Coremark Residential named Lee Dunlap. Together, we are personally investing $3 million of our $30 million total co-invest commitment. So we will personally have 10% of the overall capital as skin in the game, with the additional capital to come from partners like UPC.
Perfect. Well, if there's no other questions, guys, we do appreciate you. What stated are, Celeste, what are you trying to say? Or what stated are? refresh for a second.
Maybe what states of the investment in?
There we go.
Yeah.
There you go.
What states are you purchased in? So our operator here in Denver is in the Colorado Springs, Denver markets. He's also in Oklahoma City and Kansas City as well. Patrick, what MSAs are you in?
So historically, I've been in the Memphis, Tennessee MSA, Montgomery, Alabama, and Jackson, Mississippi. That's where I've done a lot of my deep value add workforce product. Cormark is based in Frisco, Texas, which is in DFW. And so as a state, we love Texas, between DFW, Houston, San Antonio, but we also love Nashville and certain markets within Florida. So we tend to favor more conservative, politically leaning MSAs, more landlord friendly and high economic opportunity. So that's kind of a general basis, but we'd be primarily looking at Nashville MSA, DFW, San Antonio, Houston, and some markets in Florida.
Nice.
So if somebody wants more information, what do they do?
Well, in the past, so if you ever want to look at your chat, Joe Rinderknecht has put his phone number and his email in here. If you want to know more about the new opportunities, because tonight we're not presenting any specific opportunities. Obviously, you heard Patrick's out there right now, gaining his own. Ryan Lawless has more opportunities. We're going to be finding some as well. So in the future, we'll definitely have more specific ones that you can look at. And if you want to know more, simply just reach out to Joe. He'll get you on the list of follow-ups. Yeah, I think that's all we got for now. This is an introduction meeting, get to kind of know us. So we appreciate everyone who came on and jumped on. Is there any last questions before we do jump off tonight, guys? Seems we're good. All right, gentlemen, any UPC, anything you want to add?
Thanks.
All good on my end.
Perfect. Well, thank you everyone who showed up again. Everyone is going to watch this recording. We will send it out later on tonight. Look forward for more conversations in the future. We really appreciate everyone jumping on tonight, guys. Thanks so much.
Bye.
Thank you.